Let's be honest for a second. The word investing can sound pretty intimidating. For many people, it brings up images of Wall Street traders yelling into phones, complicated charts with squiggly lines, and the very real possibility of losing all your hard-earned money. It feels like a secret club and you weren't given the password. This fear is completely normal. It's rooted in a fear of the unknown. We're taught to work hard for our money, save it, and protect it at all costs. The idea of putting that money into something you don't fully understand feels risky, like gambling it all away on a long shot. This hesitation keeps millions of people on the sidelines. They stick to traditional savings accounts, where their money is safe, but it barely grows. In fact, with inflation, the money sitting in a standard savings account is often losing its buying power year after year. That $100 you saved might only buy you $97 worth of goods next year. The fear of losing money in the stock market is so strong that people accidentally guarantee they will lose purchasing power over time. It's a classic case of trying so hard to avoid one risk that you fall right into another, much quieter but equally damaging one. The financial world doesn't always help either. It's full of jargon, complex terms, and so-called experts who make things sound more complicated than they need to be. They talk about derivatives, puts, calls, and alpha, and your eyes just glaze over. It's easy to feel like you need a finance degree just to get started. This complexity creates a barrier, making average people feel like they aren't smart enough or rich enough to participate. They believe investing is only for the wealthy, for those who can afford to lose big without it ruining their lives. But that's simply not the truth. The good news is that you don't need to be a Wall Street genius to build wealth. You don't need to time the market perfectly or pick the next big meme stock before it goes viral. In fact, the most powerful force in finance is stunningly simple. It's a concept that works silently in the background, requires very little active management, and is accessible to absolutely everyone, regardless of how much money you start with. It's a tool so powerful that Albert Einstein supposedly called it the eighth wonder of the world. This tool can transform your financial future, and it all starts with understanding one single beautiful concept. So, what is this big secret? It's not a get-rich-quick scheme, it's not a risky bet. It's something called compound interest. That's it. It might not sound exciting, but its power is unmatched over the long term. Compound interest is basically interest earning interest. Think of it like a tiny snowball. You start with a small ball of snow, your initial investment. As you roll it, it picks up more snow. That's your interest. Soon the new snow you're picking up starts picking up its own snow. Your snowball starts growing faster and faster. Let's break it down even simpler. Imagine you have $100 and you earn 10% interest in a year. At the end of the year, you have $110. Now, with compound interest, the next year you earn it on the new total of $110. The growth starts to accelerate. It's a chain reaction where your money starts working for you. This is the fundamental difference between saving and investing. When you save, your money just sits there. When you invest, your money goes to work. It becomes your employee, working to make more money. It just keeps working, compounding day after day, year after year. This is how regular people can build serious, life-changing wealth over time. They just put their money to work and let the magic of compounding do the heavy lifting for them. This is the path to financial freedom. It's about understanding this one simple, powerful principle and having the patience to let it work its magic over many years. It's the ultimate financial cheat code, and it's available to everyone. Turning $100 into $10,000 might sound like a fantasy, but with compound interest and time, it's a predictable outcome. Let's imagine you invest that initial $100 and add just 100 more every single month. Let's assume your investment grows at an average annual rate of 10%. Now let's get back to our headline. How does $100 become $10,000? If you invested a single, one-time amount of $100, it would take about 48 years to cross the $10,000 mark. The key isn't having a lot of money to start with. The key is starting. Your first $100 is the most important because it's the seed from which your financial future can grow. We will break down exactly what compound interest is, how it works, and the simple, practical steps you can take today to begin your journey. Compound interest is the interest you earn on your initial principal plus the accumulated interest from previous periods. It's a two-for-one deal for your money. This process repeats, creating a cycle of growth that gets more powerful with each turn. Albert Einstein said, "Compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it." Let's imagine you plant a money tree. Over time, you have a massive forest of money trees, all stemming from that one single seed you planted years ago. It turns the passage of time into our greatest financial ally. Let's see compounding in action against simple interest. Imagine Alex and Ben, friends who each receive a $1,000 gift. Both invest at 10% annually, but Alex gets simple interest, while Ben gets compound interest. Fast forward to year 10. Alex earns $100 each year, totaling $2,000. Ben's account, compounding annually, grows to approximately $2,594. After 30 years, Alex has $4,000. Ben's account, thanks to compounding, reaches a massive $17,449. The difference? The power of compounding. Compound interest is like a snowball rolling down a hill, slow at first, but unstoppable over time. In the beginning, your gains are tiny, maybe just enough for a coffee. But stick with it each year, your interest earns its own interest. As your investment grows, so do your returns. $1,000 earning 10% is $100, but $10,000 earns $1,000. The magic is in the acceleration. The bigger your snowball, the faster it grows. Over decades, your yearly gains can surpass your original investment. Consistency beats timing. Keep adding to your snowball and protect it from unnecessary spending. Time and patience do the heavy lifting. You just need to keep the process going. Let your money work for you and watch small actions turn into life-changing wealth. That's the real power of compound growth. Compound interest is your money's best friend because it works for you, even when you're not working. Unlike your job, it never takes a break. It grows while you sleep. It's the best defense against inflation, helping your money outpace rising prices. Over time, your investments start earning more than you contribute. This shift means your money is working harder than you are. Compounding is available to everyone, no matter your background or income. Whether you invest $50 or $5,000 a month, the principle is the same. It's a universal tool for building wealth and financial security. Start now, and let compounding shape your financial future. The most powerful ingredient in wealth building isn't money, it's time. Time lets your investments grow and compound, turning small amounts into fortunes. The earlier you start, the longer your money has to multiply. Waiting even a few years can dramatically shrink your results. A 20-year-old investing $100 a month will likely outpace a 40-year-old investing $500 a month. You can always earn more money, but you can never get back lost time. Don't wait for the perfect moment. Start with what you have now. The act of starting is more important than the amount. Your youth is your financial superpower. Use it. Begin today, and let time work its magic. Let's see the power of starting early with a story of twins, Chloe and Zane. Chloe invests $200 a month from age 25 to 35, then stops but leaves her money to grow. Zane waits until 35, then invests $200 a month until age 65, 3 times Chloe's total contributions. At 65, Zane's account grows to about $442,000. Chloe, who started earlier and invested less, ends up with over $685,000. Her 10-year head start made all the difference. The lesson? Time in the market beats total dollars invested. Start as soon as you can, even small amounts matter. The earlier you begin, the more powerful compounding becomes. Don't wait for the right time. Start now. Your future self will thank you. Even a single year of delay can cost you a fortune. If you invest $5,000 a year for 40 years at 10%, you could end up with $2.65 million. Wait just 1 year to start, and you'll have about $2.41 million instead. That's a $240,000 difference from missing one contribution. The first dollars you invest are the most powerful. They have the longest to grow. Every year you wait is a year you can never get back. Don't underestimate the cost of procrastination. Small actions today have massive consequences decades later. Start now and let every year work for you. Your future wealth depends on it. Every dollar you invest today is a gift to your future self. Investing isn't just about money. It's about freedom and options. A healthy portfolio lets you handle emergencies, change careers, or retire early. Automate your investments so saving becomes effortless. Pay your future self first before spending on anything else. The small sacrifices you make now will create a life of security and peace of mind. Don't focus only on numbers. Think about the life you want to build. Start planting your financial seeds today. Your future self is counting on you. Now that you understand compound interest, where should you put your money? The world of investing can seem confusing. For a beginner, this is often the most paralyzing step. Instead, you can buy a tiny piece of the entire market through an index fund. An index fund holds all the stocks in a specific market index, like the S&P 500. The S&P 500 is a list of 500 of the largest companies in the United States. You are diversifying your money across the entire economy with a single purchase. First, it's incredibly diversified. Second, it's a passive strategy. Historically, this has been a very good bet. Warren Buffett has repeatedly said that a low-cost S&P 500 index fund is the best investment most people can make. If it's good enough for Buffett, it's an excellent place for a beginner to start. It takes the guesswork out of investing. When investing in an index fund, you'll typically buy it as a mutual fund or an exchange-traded fund, ETF. These are just different wrappers for the same investments. Both allow you to buy a diversified portfolio of stocks or bonds in a single transaction. ETFs are the newer version and trade like a stock. A huge advantage of ETFs is you can typically buy a single share. For a long-term investor, the difference is minimal. Pick a broad market index fund, like the S&P 500, and ensure it has a very low expense ratio. For most beginners, the flexibility and low cost of ETFs make them a slightly better choice. While a simple stock market index fund is a fantastic foundation for any portfolio, it's not the only option out there. As you become more comfortable with investing, you might want to consider other types of assets to further diversify your holdings. Two of the most common alternatives are bonds and real estate. These assets behave differently from stocks and can add stability to your portfolio, especially as you get closer to your financial goals. Think of stocks as the engine of your car. They provide the high-octane power for growth. Bonds, on the other hand, are like the brakes in suspension. They provide safety and a smoother ride. Bonds are essentially loans. When you buy a bond, you are lending money to a government or a corporation. In return, they promise to pay you periodic interest payments over a set term, and then return your original investment, the principal, at the end of that term. Bonds are generally considered much safer than stocks because their returns are more predictable. They won't give you the exciting 20% growth you might see in a good year for stocks, but they also are much less likely to drop 20% in a bad year. Adding bonds to your portfolio can cushion the blow during a stock market downturn and reduce overall volatility. Real estate is another popular way to build wealth. This can range from buying a rental property to investing in a real estate investment trust, or REIT. A REIT is similar to a mutual fund, but instead of holding stocks, it holds a portfolio of income-producing properties like apartment buildings, office towers, or shopping malls. Buying shares in a REIT allows you to invest in real estate without the hassle and expense of being a landlord. REITs offer diversification and tend to pay out high dividends, providing a steady stream of income. They give you a piece of the real estate market with the same ease as buying a stock or ETF. For a true beginner, it's best to keep things simple. Starting with a single low-cost broad stock market index fund is more than enough to get you on the path to financial success. You don't need to overcomplicate things by immediately jumping into bonds or real estate, but it's good to know these options exist for the future. As your portfolio grows and your risk tolerance changes over time, you may decide to add these other asset classes to create a more balanced and resilient investment strategy. For now, focus on getting that first snowball rolling with a simple stock ETF or mutual fund. Now it's time to move from theory to action. The very first step is to figure out why you are investing in the first place. Without a clear goal, you're just driving without a destination. Is it for retirement, a down payment on a house, or financial independence? Get specific. A better goal: $1 million saved for retirement by age 60. Putting a number and a date on your goal makes it real and measurable. Take a few minutes, sit down, and write out your goals. This simple act will build a powerful foundation for a lifetime of successful investing. To invest, you'll need an investment account, also known as a brokerage account. These accounts allow you to buy and sell things like stocks, bonds, ETFs, and mutual funds. Choosing the right account is important because some come with incredible tax advantages. For most, start with a tax-advantaged retirement account like a 401k or Roth IRA. If your employer offers a 401k with a company match, this is an absolute no-brainer. It's free money. The other powerhouse account is the Roth IRA, where your money grows completely tax-free. Contribute enough to your 401k to get the full match, then open a Roth IRA. You've set your goals. You've opened the right accounts. Now comes the final, crucial piece of the puzzle. Building the habit of consistent investing. The single best way to do this is to make the entire process automatic. You know, human beings are creatures of habit, but we're also really prone to forgetfulness, procrastination, and emotional decision-making. By automating your investments, you remove your fallible human self from the equation. You create a system that works for you, ensuring that you invest consistently every single month without ever having to think about it. This is honestly the secret to building wealth effortlessly over the long term. Here's how it works. Once your brokerage account is set up, you simply link it to your regular checking account. Then, you set up an automatic transfer and investment plan. You can instruct the brokerage to pull a specific amount of money, let's say $200, from your checking account on a specific day, like the day after you get paid. You can then instruct it to automatically use that $200 to purchase shares of your chosen investment, like that S&P 500 index fund ETF we talked about. The entire process happens in the background. The money is invested before you even have a chance to see it, think about it, or spend it. This strategy is often called paying yourself first. And honestly, it's a complete game changer. Most people do the opposite. They get their paycheck, pay all their bills, spend money on wants, and then see if there's anything left over to save. Often there isn't. Paying yourself first flips the script. Your investment contribution becomes the very first bill you pay. It's treated as a non-negotiable expense, just like your rent or mortgage. This simple shift in mindset and process guarantees that you will always be building your future, regardless of what other expenses pop up during the month. It forces you to live on the rest, not save what's left. Setting this up takes maybe 30 minutes of your time, one time only. But the impact of that 30-minute task will echo for decades. It turns investing from a difficult emotional choice you have to make every month into a silent, invisible habit that just happens. It's the ultimate set it and forget it strategy. This is how you build a multi-million-dollar portfolio on an average salary. Not by being a stock-picking genius, but by creating a simple automated system and having the discipline to let it run, untouched, for decades. This is the final practical step to put your wealth-building journey on autopilot. Now that you have a plan, it's time for a dose of reality. Investing is not a smooth, straight line up. The stock market is a volatile place, and its value will fluctuate daily. The journey to building wealth is more like a wild roller coaster, with thrilling highs and stomach-churning drops. Your biggest challenge will be managing your own emotions. The two most powerful emotions you will face are fear and greed, and both can be destructive. Your job is to stay buckled in and ride out the storm. The antidote to both fear and greed is your plan. Taming your emotions is the final boss of investing. Beyond the emotional roller coaster, there are a few common pitfalls that trip up many new investors. The first is paying high fees. They're small, barely noticeable, but over decades they can eat away at your foundation. The second major mistake is chasing fads. You're at risk of being the one left holding the bag when the bubble pops. Another trap to avoid is listening to hot tips from friends, family, or people you see on social media. Your best bet is to ignore the noise. Do your own simple research, and stick to your long-term diversified plan. Finally, do not invest money that you will need in the short term. The stock market is for long-term goals only. Short-term money should be kept safe in a high-yield savings account. We've covered a lot on this financial journey, from understanding compound interest to emphasizing that time, not just money, is your greatest asset. We've laid out a clear blueprint. Invest in low-cost index funds, automate the process, and stay consistent and patient. You have the knowledge. Now take that first step. Choose to start today. The sooner you begin, the more powerful the results.